It's February 2024, and we've got an update for you on the commercial real estate market, mostly here in Austin, a little bit nationally. So we're going to dive right into the stats and talk a little bit about that. I'm David Shapiro, my colleague Lee Abraham. We're with the Shapiro Group here in Austin, Texas, and we provide services to buyers and sellers of both commercial and residential real estate. So if you have a need, please reach out. We'd love to chat with you. Looking first here at the investment volume, you can see that fell over the last year. And Lee, do you want to tell us a little bit more about what you're seeing here?
Well, basically, David, the market shrank. I mean, it's a fairly significant dip year over year, over 40%, 44% to be more precise, drop in volume. And, you know, the inbound cross-border investment also down, not quite as large a drop, a 30% year over year in the fourth quarter. So significantly smaller market. And let's see what that means in terms of some of the sectors.
So here you can see the investment volume going back to 2012. And don't really worry too much about the different colors, but you can see relatively steady in here. This is the Q4 average from 2015 to 2019 is this yellow line. Big jump up in 2021. You can see Q4 2021 was a big year. And then we've seen a big drop off in the amount of investment over the last 4 quarters.
Right. This is really some of the interesting elements as we get into the types of investment, David. And you can see that multifamily continues to be the largest sector, yet 51.4% drop. So that's just over, 30% of the market dropping, about 50% in volume, followed by industrial, then office space, and these are just based on the billions of dollars in each of those sectors. So pretty much across the board, you're looking at some very significant drops.
Yeah, I think people will probably be surprised that office saw a 33% drop versus some of these other sectors didn't see as big of a drop off. Might be just the timing. We're talking about 2022 versus 2023. Office maybe already took a big hit by that point. And then some of that stuff bleeding into these other asset classes. I mean, multifamily impacted greatly by a change in interest rates because things there are sold off of a cap rate. If you're not familiar with commercial real estate, the cap rate, we have another video explaining that. So go check that video out. But basically that impacts the value and the ability for people to invest in multifamily. So that's why we see such a big drop off there. All right, here we've got the volume year over year by market. So here you can see billions. And so this bar in greater New York, it's 33 billion, let's say. And it's also down by 40%. LA down by 46%. So you can see all these different markets. And it's a range, right? Down from in the 40% up to, I think I saw 70% here for Seattle. So big year over year changes in these markets. And there you can see Austin highlighted at down 54%. Interesting, our larger city to the south, San Antonio, which population-wise is a bigger city, has a lower investment volume, although it did see a lower percentage drop-off, so not as big of an impact there.
Across the great state of Texas, Dallas-Fort Worth is a huge market, down 56.6% year over year. Houston as well, north of 55. San Antonio fared pretty darn good compared to the other major markets in Austin. And interestingly, David, New York not only leading in dollar volume, but also having the smallest year over year decline across these major markets. So to me, this is a dynamic flow chart showing where the money is flowing from and to. Who are the buyers? Who are the sellers? So in that left margin, you can see private buyers and sellers, institutional, then the investment trust, public companies, cross-border, and so forth. And as you kind of scoot over to the right, you can see who is buying and selling. And you can see that the big players, the institutional, the REITs are selling. They're faced with various pressures that are bending to the will of the market. And then more on the private side and even cross-border, more opportunistic in timing the market, if you will, and buying on the dip. So to me, it's very interesting, and we can extrapolate some of that out to helping our viewers make their investment decisions, should they be a buyer or a seller.
So taking a look at Austin, so this is for the city, and here in a minute we'll talk about the metro area, but the city has a population of just shy of 1 million, and it's forecasted that's going to continue to grow. You can see this goes all the way back to 1860. I moved here in the mid 2000s. We had a population of around 800K, and now we're nearing 1 million. Looking at the whole metro area, you can see that we're sitting at about 2.2 million people, and it's anticipated this is going to continue to grow. Here's the rate at which it has grown. You can see it's generally in this 3 to 4% range, bumped up in the 90s to north of 4%, and then in the 2000s came back down to just the low 4%, and then here it looks like it's going to come down, and they're projecting that the rate that we're going to grow is going to decrease. Still going to grow, just not as at fast of a percentage rate as we have in the past. And we've been the fastest growing area in the nation for the 12th year in a row.
Yeah, to me, David, just as a macro trend, obviously the slowing pace of growth is something to factor into forecasting, but just from a broad perspective, the growth rate, although slowing, is continued to be a positive growth rate for the Austin MSA. And when we're driving supply and demand, basically that's one of the big keys to keeping things moving up rather than spiraling into a decline. So this is kind of interesting as we look month to month in terms of job growth. And so the bottom line is that we're still creating jobs. If you look at the little bullets there inside the graph for the December 2023 numbers, 8,200 private goods producing jobs, 19,000 private sector service jobs, 5,600 government jobs. Those are the main contributors to where the jobs are coming from. And you can see for a couple of the months, January and July, there also December, a net retraction. But overall, just over, 32,000, 33,000 jobs created. Not as robust as prior years, but still a very strong job growth environment. So David, here we're parsing out some of the various employment sectors. And the best way to interpret this is looking at that aqua color line, which is December 22 to November 23, essentially a year-over-year change. So you can see that there's only 2 year-over-year declines, which is manufacturing, which was under 1% at 0.6, and then information jobs down 4.0. Relatively small in the greater scheme of things. All of the other sectors saw a year-over-year increase. That's everything from trade and transportation to government to construction and mining, for example. So a fairly balanced economic base is the key here. No over dependence on any one sector to provide the job growth, and that's an important variable as we look at diversification of risk.
And here's the unemployment rate. So you can see Austin, the US, and Texas, and obviously the big spike here up in 2020 during the pandemic. And we're faring really well with a super low unemployment rate, nearly as low as it was prior to the pandemic. We haven't quite gotten there yet, but certainly really strong for anybody looking for a job in Central Texas to know that the unemployment rate is so low. All right, let's talk about multifamily.
So as we look at this chart, David, we're basically talking about how many units have been completed versus how many have been absorbed. We've been reporting on this for quite some time that there's been a huge spike in development. Catch up with some of the pent-up demand. Well, that's beginning to surpass the demand, and you can see that illustrated with the dark blue bars, which are basically what's been completed. The gray bar to the right of the dark blue bars is the absorption, and you can see that there's an oversupply. And so as we look at the vacancy rate in orange, it's correlating perfectly as it should based on the fundamentals. You get an oversupply, you're going to have an increasing vacancy rate. This isn't changing right away. There's significant upward pressure on vacancy. We're at a 20-year high, basically, for the Austin MSA at 8%. And when we look at the next slide, we're going to see what it really comes down to in the form of rent trends. So here you can see the dark blue line is the average rent, and you saw a slight dip from 2022 to 2023. That's forecasted to bump up ever so slightly in 2024, and then the orange is the rate, the year-over-year percentage change, and you can see a couple of years of decline in the rate, and then a forecast bumping upward. So what does it mean? Basically, it's saying that right now we're in a period of transition, that rents have been coming down a little bit. They're going to stay low, but they may bump up just a bit due to the fast-growing demographic of young folks, young professionals moving to Austin, primarily driven by tech, and we're looking for that to continue. So if you are looking to invest in multifamily, if we put some of the puzzle pieces together, we looked earlier at who the buyers and sellers are on the national side. The large players are more likely to sell than to buy. If you are a small or mid-size investor, that may or may not be an opportunity for you. But for our clients that can acquire larger properties, my sense of it is the bigger the property, the greater the opportunity to strike a bargain as the supply and demand are shaking out, because there's a lot of pressure on those institutional sellers to hit their margins and hit their metrics. For smaller investors in multifamily, you also have an opportunity, particularly because the news is filled with a lot of doom and gloom, and it just takes one seller matched with the right buyer to strike the right bargain for both parties. So I think there's a lot of opportunity, David. It's a matter of really being careful with the numbers and forecasting, not getting overly optimistic on rent increases going forward, and making sure that there's a good vacancy factor built in as well. But I see a lot of opportunity to buy on the dip for our clients.
All right, I'm taking a look at office. So this is an interesting one, as the work from home trend is, at least amongst people I talk to anecdotally, they love working from home. They want to stay working from home. And then there's the people that do like going into the office occasionally. They like being able to mix it up, but very few people want to be in the office 5 days a week. So how is that impacting what's going on in the market?
Well, basically, it's the same story as multifamily, but more extreme. You've got a bigger disconnect between the completions and the absorption, and the vacancy rate bears that out. So I love it when the fundamentals do what they're supposed to. Unfortunately, this isn't great news for equity holders, particularly of large office buildings. The magnitude of what's going on here, we've got a saturated market. You've got the sublease going on. There's a lot of dynamics, as David was talking about, with the folks who are actually populating these offices. And then the next slide shows us what it means in terms of forecasted rents. And so the trend is on a downward pace that's looking to continue. It's hard to say exactly when this is going to turn around. And again, opportunity. We've talked about our clients who are owner users. And so particularly in the office space, I think there's huge opportunity if you're currently leasing office space for your business, your operation. Take a good hard look at acquiring that, purchasing and investing in office space, because now's a great time to purchase on the dip and then turn that expense into a wealth creation opportunity through paying down a mortgage, value appreciation, which ultimately is going to kick in, and also the tax shelter that you get. So I wouldn't be planning on building new offices right now, David. That's one takeaway.
Yeah. I mean, I think there's a lot of fear out there about what's going to happen with the office market and some of the other commercial markets. And we know that when people are afraid, there's blood in the streets. As the saying goes, it's the time to buy. So, if you have a need, you're going to be paying rent anyways for an office space, and your lease is coming up. You might as well buy at a low point in the office market. And there's a lot of ways to strategies to have in place to make sure you're secure. We love buying office spaces for clients where there's potential future development opportunities. So they're not stuck with an office forever. If the market continues to evolve in this way, an office doesn't ever come back, then they can easily develop it and create something that is more usable. So there's strategies around this, and we've helped clients do that before. So if that's something that you're interested in, please go ahead and reach out to us. We'd love to set up a time to chat. And if you got a lot out of this video, please go ahead and like it so other people can find it. Leave us a comment if you have any questions or thoughts. We love comments. We try to get in there and answer all of them. So go ahead and do that. And go ahead and subscribe so you can get updated for our next market update and other content that we have coming your way. So thank you for joining us. We look forward to chatting with you.
Thanks, everybody.